taking a test in tax class. With Monique, you had one semester of taxes, didn't you? We had to do a tax return for a person who had been dead 2 years. He had just all of a sudden his wife got a a W-2 2 years late after his death, and last year she survived filed as, I guess, single because they had no kids to file surviving spouse or head of household. So we had to keep her same filing status, single, and we had to do one for him. So it was hard to call it whether to do a separate return for him or couldn't do a joint return. Anyway, we had some funny situations. And then one feller, Clayton, he was having, I don't know, it might have been you doing his return. He had his and he had a friend's and he had that bag full of stuff. Now, we don't have time and didn't have time to separate a bag full of stuff. But I feel sorry for him and her too, because she probably didn't know him better and she sent everything. And we only want tax documents. And, but you'd think even an older person would have a child, a grandchild, or an in-law, or somebody that could help them separate tax papers from just pure junk. You know, we just didn't have time. I used to have, when I had a tax business, people would bring in a box of stuff. Maybe they had a small trucking company. I said, if you want me to go through that box, that's a year of accounting or bookkeeping. I will charge you for a year of bookkeeper if I go through there and pick out your income from every month and your expenses for every month. But now if you take this box home and list your income total for the year and your expenses categorized for the year, I'll do your return a whole lot cheaper. So, but we get all kinds of messes there. Clayton, did you enjoy doing taxes?
Yeah, it was fun. It wasn't too hard. It was pretty...
Is that not a good way to get 3 credits? 10 weeks? No homework, no book, no test? So how many did you end up doing?
I think I had like 50 or 2 or 3. I think I got one of them. I think we said it counted twice. On that'd be about 54. And I'm right there at the moment.
Yeah. Okay, you did good. So sound like you did enough to get an A out of class. So that's good. Okay. 2 of you here today. 5 of you missing. I guess that's Terry and Hillary and Jonathan and Cole and Savannah. Savannah knows about the test. She must take it. She's already getting behind. Cole, I guess, and Jonathan know about the test, or we can tell them the day in taxes, whichever. Terry and Hillary. So I thought they'd be here in Costa County too, since they'd be here for taxes. But they're not. Now, you're going to have 3 problems on your test. Now, I told you about one of those problems yesterday. You'll be calculating all those variances. Now, from that chapter on variances, you can have a half a page of notes. Now, you should look at, and here's 2 questions I want you to think about before this test. When you're doing material variances, are you taking materials purchased or materials used? Check that out in your book, put it in your notes. Now, also check this out for that one problem. If I gave you a material price variance of $1, and I gave you the standard materials. Could you find the actual then? Now, you know, we only need 2 or 3 variables usually to find the third one. If I give you actual standard, actual, then standard, you take the difference and you get a material variance, the overall variance. But if I gave you the variance and actual, can you give me the standard? All right, so check in on that one chapter. Okay, now the chapter on budgets. I think I gave you an easy cash budget on this test. I don't think I had any discounts there. In fact, I read you the same problem the other day. I'm going to give you the same problem. I'm not going to put a discount on it or uncollectible on it, like the 1% uncollectible. So I expect you to do great on that cash budget. And if you only got 3 problems, you know they both count a whole lot. All 3 count a lot. I'm giving you an easy third little problem to help you along with the budgets and its collections and disbursements only. So there's your 3 problems. Now the collection and disbursements will probably count maybe as 20 points. And your cash budget will count as 30 points. That's 50 points on one chapter. And then all your variances will be 50 points on the other chapter. So please be prepared for those 2 chapters. Now that brings us into a new chapter called break even. Okay. Of course, Clayton, if you had $1,000 for this month and you spent $1,000, you can say, hey, that's break even. That's not what we're talking about. Okay. Or I'm in a poker game. I started out $10. I ended up at $10. I broke even. That's not what we're talking about. Okay. So we're talking about this chapter 9, which will be on your exam. So we'll have 3 chapters on your exam. 1 chapter I won't get to cover that I wanted to, maybe on capital budgeting. I never do, so I don't feel too bad about it. Now, folks, this is an easy chapter. It's easy for me, and it's easy for you to do a break-even analysis. All right. You can look at all these letters that you want to on page 356. But I'm going to give you a simple formula that works pretty much all the time. Use their formulas anytime you want to. Break even is equal to fixed cost over 1 minus variable cost. All right. Now, if you look at these formulas on page 356, they may come up with something similar. They will on another page, but look at their abbreviations on page 356. You know, FC is fixed cost, VC is variable cost, 1 is total cost. All right, now, let's say that you had a business selling CDs, and your fixed cost for the whole year, was $25,000. All right, let's say your variable cost. Now, when I say 1 minus your variable cost, you know, we can do that in percentage, but to do it in dollars, I've got to take the sales price minus variable cost to do it in dollars. The way I was doing it is percent. Now, let's say the sales price of a CD is about $15, and your variable cost is about $10. Okay, so Clayton, you should be able to work that now. Selling price minus variable cost is equal to 25,000. So that's 5 into 25,000. What's your answer? All right, let me take this part of the formula away. Now, what's your answer? Well, I'm sorry. This goes up here. My bad on that one. It's 25,000 divided by what? All right, that gives you what, Monique? All right, I want you to keep these numbers in mind. So if we sell 5,000 units, we're supposed to break even. If we sell 5,000 units, we're supposed to break even. So to check that out, now your book may not show you this, but it's simple, very simple. Sales minus variable cost is equal to contribution margin minus fixed cost is equal to net income. And we had that in past chapter. Now, what's your sales here if we break even? 5,000 times how much? What I say the selling price was? All right, so what is that? Sales will be what? 5,000 times $15. Come on, get your calculator and check, but it's 75,000, right? Now the variable cost is how much a unit. All right, what is 10 times 5,000? Okay. Your contribution margin is 25,000. And what is your what is your fixed cost? All right. So what is your net income? And that's what we mean by break even in accounting. We make zero net income. All right. Now that's one way of looking at break even. We're going to be looking at it in percentages also. But if you keep that one formula I gave you in mind, break even is equal to fixed cost over one or selling price minus variable cost. Keep that formula in mind. It'll go a long way in this chapter. Okay, so your fixed cost is equal to 100,000. Selling price, $20 a unit. And your variable cost is $16 a unit. Now find me break even. So now what's break even? What'd you get, Clayton?
Uh, 100,000.
So that's your fixed cost. Are you using my formula up here?
Oh, the break even is 25,000.
Right. Did you get 25 on these?
Okay.
All right.
I couldn't.
Yeah, okay. Break even is 25,000. Now, to prove that, I want you to take my little income statement here
All right.
and prove that that's break even. I want you to prove that 25,000 is break even. The sales is how much? 25,000 times.
500,000.
All right. So you'd already done that part, Clayton.
Yeah, I did.
And then 25,000 times 16 is what?
400,000.
And your contribution margin? You see, the contribution margin pays your fixed cost plus net income. And your fixed cost is 100 and your net income is 0, isn't it? All right, now let's go back to that 5,000. That was CDs. I don't know what this was, a gadget or a gadget. Now we got to sell 5,000 CDs a year to break even. And we're open 52 weeks a year. Let's say we're closed 2 weeks out of the year. Let's say we're only open 50 weeks out of the year. How many CDs do I have to sell a week? I'd have to sell 100 a week. Now, I don't know how many hours we're going to be open. We may be closed on Sunday. We may be open Monday through Saturday. Maybe we're open 50 hours, let's say just 40 hours a week. We'd have to sell how many CDs? Wait a minute.
2.5.
2.5 per hour, right? So you can do a lot with break even if you want to take it further like this. The other situation, you had 25,000 break even. And let's say you were open 300 days a year instead of we're not going by weeks. How many will we have to sell if we're open 300 days a year? Get away with Sundays and holidays. I would have to sell 83.3 a day. And if you're open 8 hours, you got to sell at least one an hour, one or a little more than one. All right, so that's the background on break even. Very easy concept. Now, if you have homework in this chapter on page 357, graphic approach to break even, you do not have to do graphs. The formula is better, and this is a traditional approach with a graph. I don't want you to buy graph paper, and I don't want you plotting graphs. Hopefully you do that in quantitative techniques, okay? So now, let's look at page 361. Now here's what they're telling you, you want to profit. Now, you can look that over, but here's the way I want you to think about it. Okay, now our fixed cost, let's say, is equal to 50,000. Our sale price, an easy $10. Our variable cost is $8. What if I want to make a profit that year? I don't want to work for nothing. Or I want to pay myself a salary. Maybe this year, maybe this is a month. Now, if it were a month, I'd want to make at least 5,000 a month. If it for a year, I'd want to make 60,000 a year. So let's say we want to make, now let's say this is for a month. Now I want to put 5,000 in my pocket every month. So my formula becomes simple, much more simple than what the book is showing. Then break even is equal to fixed cost plus profit, desired profit or net income, over selling price minus variable cost. Now find me break even that has that profit in it. All right, how many do we have to sell? Wait, on it? Only 7.5? All right, without me working it out, let's check it out. All right, do that contribution margin statement again, which is an income statement based on the contribution margin format. All right, let's take sales. All right, 27.5 times how much? What? 10? I'm on 8, that'd be 275, wouldn't it? All right, my variable cost is 27.5 times what, 8? How much is that? 220? My contribution margin then is 55. And my fixed cost is how much? And that leaves me a profit of how much? That's what we wanted, wasn't it? So we have a net income, which we want to count it as our salary, a net profit per month, so we can put it in our pocket. So again, break even can be useful in business, anywhere, anytime. Okay. Starting on page 361 again. Now I want you to look at their, on page 362. Now here, I want you to look over this formula. We're going to have to deal with it in problems. We got fixed cost, contribution margin. We want to cover fixed cost plus profit before taxes. That's easy. That's what we just did. 5,000 is profit before taxes, isn't it? But you know, if this company was being charged a 20% tax rate, profit after taxes is 80% of profit before taxes, isn't it? So that's what they're trying to tell you here, and that's what PBT means, profit before taxes. Hopefully they have profit after taxes. All right, we're going to look at that. We will. I won't leave you in the dark on it. I can illustrate the problem better than the way they're illustrating. Okay, let's look at page 364. We haven't left break even by any means. I want you to look at that one word at the bottom of page 364. Do you have your cell phone, Clayton? Monique? I'm going to let you use them now to find the definition for incremental. Not analysis, just incremental. What does it say, guys? One of you.
Relating to an increase or addition, especially one of a series of a fixed scale.
All right. What does that increase bring? Now, if my break even is 5,000 units, and then I can sell 6,000, that incremental sales is 1,000. What does that do to my incremental income? It might bring it up from 0 to a couple of thousand a month or a payday or however you want it. Incremental means that extra. So that's all page 365. If sales is 400,000, your variable cost, contribution margin minus your fixed cost gives you profit before taxes. Now, what is your break even here? Look at that chart and tell me which one is break even. Come on, page 365. The beige box, how many units is break even? Which one has a profit before taxes of 0?
Basic.
Sure, 400,000 is break even, then isn't it? Okay, but let's say we produce 700,000. 300 is incremental. Your variable cost goes up per unit. Well, what happens to your fixed cost? It stays the same, don't it? Now, whether you break even, your fixed cost is 4.4 million, or whether you sell 880,000, your fixed cost is 4.4. So you're making more profit per day or more profit per hour simply because fixed cost stays the same. You know, these little old folks that came to taxes last night, how come I have to pay in more this year than I did last year? They had some incremental income. Last year they had 5,000 plus Social Security. For some reason this year they had 20,000 plus Social Security. And one man with his Social Security, the one they were working on back there with Cole, he'd gotten a lump sum Social Security, 74,000, no taxes. He had gotten 60,000 maybe in retirement, no taxes, maybe 1,200. He went no way owed taxes. Well, lump sum Social Security, what he got for 2016-17, you know, the tax program taxed him on just 85% of that. But he has to pay taxes. He didn't like it. It's like we had a professor, you know, we did his taxes. He had 35,000 in self-employment income, no expenses. He didn't want to pay taxes. Okay? Incremental. And people has to understand that in taxes. Okay. Now, margin of safety, page 367. We have not left break even whatsoever. Now, this little formula you can have written down. This little formula you can have written down for test purposes. That would be the exam. All right. Not working like it's supposed to. Let me see. Might work. Now, what is that formula, Clayton, for margin of safety? Can you read that to me?
What page?
Just a minute. On page 367. What is that formula for margin of safety?
Margin of safety in dollars divided by actual sales.
Actual dollars. All right. Margin of safety. Okay, let's do that in dollars. And we also can do it in units. But now, Clayton, you're misreading that. That's the second line down. Margin of safety in dollars is what?
Oh, no, I read the one at the bottom. My fault. Actual sales in dollars minus break-even sales in dollars?
Yeah.
I was reading the bottom. It says or.
All right, now that's margin of safety is equal to actual sales minus break-even sales, right? All right, now let's do that in units. And Monique, that's the first line that Clayton skipped. What does it say? All right, that's actual sales minus break-even sales. So we're going to have to put a little u down here. I mean, a little U here for units and a little dollar sign here for dollars, okay? But that's the formulas you're looking at. Actual sales and units, actual sales, and you can have those little formulas written down for test purposes. You can have any of these break-even formulas written down, okay? Margin of safety. All right, let's look at page 368. Here we got multiple products. Now, there's not very many stores out there that sells just. Well, what does ABC store sell? Just alcohol, I guess. But they sell different kinds of alcohol, from bourbon to whiskey to vodka to maybe wine, what have you. But they could do a break even. Okay, a CD store. What else does a CD store sometimes sell besides CDs?
Perhaps clothes of the fans.
That's possible. What do you call that? Paraphernalia or something like that. Anyhow, well, they may sell movies. But look at page 368. This Kalispell company, multiple products. Here they're selling clocks and what else? What are they selling with those clocks?
One wall mounting kit.
Yeah, wall mounting kit. Now, selling price is $40 for a clock, $10 for wall mounting wall mounting kit. All right, variable cost is $29. Now, for a clock, how much profit are you making, or contribution margin? You're making $11, right? Now, for a wall mount, what is your profit? Come on, what's your contribution margin for a wall mount?
$7.56.
Oh, come on, no, you're looking at the wrong number. What is your contribution margin in dollars for a wall mount? All right. Now, what was your contribution margin for the clock? How much? I want you to add those two together. What do you get? Now divide 6 by 17 and divide 11 by 17. Clayton, you do 11 by 17 and Monique do 6 by 17. Clayton, what have you got?
0.64.
I'm trying to look. You got point what?
64.
What you get, Monique?
3.5.
Oh no. 17 into 11 goes more than that. Try that again.
No, she had 6. She had 6. I had 7.
0.35. And yours was what, Clayton?
0.65.
Got to round off. Got to make 100. Okay, I'm wondering if that's what they're doing here. Total fixed cost. Now here they had percentage 27.5 and percentage of 60. I don't know where they're. Okay, they're looking at gross margin percent of 27.5 after you take sales price minus variable cost, 27.5, and 100 minus 40 is 60. We may not need these percents then for this particular break even. right, now let's look at clocks down here in the second chart on the same page. Number of products per bag. Revenue per product is $40. Total revenue per bag, there must be 3 clocks in a bag, 140. Variable cost per bag, that's 29 times 3 is 87. Contribution margin per clock is 11, but per bag is 33. That's 3 times 11. All right. And you have that same breakdown over here with wall clock mounting kits. What have they done here? They got break even in units. All right. You've got 39B is equal to 4,914,000. Where'd that 4,500,000 some thousand come from? We got to get break even of 126,000 bags. All right, let's see.
That's how much it is per bag for 3 clocks and the mounting kit. Added up was $39.
30. Okay, now how'd you get that?
33 plus 6.
33 plus 6. Okay, look at that. Yeah, I was looking over one column too much. Okay, so we're adding the contribution margin for a bag of clocks and a wall mounting kit, aren't we? Okay, 33 plus 6 is 39. But now where are we getting the 4,914,000 at? It's got to give it. Now look up here at the top chart. Total fixed cost is fixed cost minus 4,400,000 previous divided by 414,000 additional is equal to 4,914,000. That's your fixed cost. That's given. You see that? Okay, so 39B is equal to 4,914,000. So divide 4,914,000 by 39, and you've got break even is 126,000 bags. All right, we'll work more with that later also, and we'll practice problems. Now, operating leverage. And we've got a product, multiple products, or product mix. Now let's go ahead and look at leverage on page 370. Now, a degree of operating leverage, they call it DOL. Okay. I'm glad it wasn't DOA. Okay. Now, DOL is simply contribution margin, which you understand now, minus profit before taxes. We can call that income before taxes, earnings before taxes. By now, in accounting, you ought to know that earnings and income and profit is about the same thing, if not the same thing. Okay? So if we know our contribution margin, if we're looking at page 370, they're looking at degree of operating leverage is contribution margin. Now, look at that again. That's contribution margin makes a difference. Not minus, not plus, but it's division, isn't it? So if the contribution margin is divided by profit before taxes. Now, if we're looking at the current 100,000 clocks, profit before taxes is 2,200,000. Contribution margin is 606,000. 6,600,000, 2,200,000. Let me try to pronounce stuff straight and correct. All right, what does that give you when you divide? 3. What is my degree of operating leverage? 3. Now, folks, calculate the same thing for 720,000 units. You take, what do you take? 3,520,000? Divide that by what? That's profit. Wait a minute. What's contribution margin?
7.9 million.
Yeah, I'm doing something wrong here. I need more room. Contribution margin is 7.92 million. Now, what will that give me? Yeah. What? 2.25? All right. You can have that formula written down for your test. So far, we've had break even in dollars. I'll give it to you in units later. Now, we've had break even in units. I'll give it to you in dollars later. We've had margin safety, and we've had operating leverage, and we've had more than one product to do a break even. And that's the one we got to practice. And that's the chapter, folks. And what we're going to do right now is get one concept out of the way, and that's break even. All righty. Let's look at number 16 on page 378. All right, see how much you could do on number 16. Number 16, page 378. Take a minute to be working on that, and we'll look at it in a minute. Okay, let's just see if we can do something with this and together. Now we know contribution margin is equal to selling price minus variable cost. Now that gives us, that's another formula if you want it to be a formula. Now what is the selling price in this problem? All right. And the cost is how much? Whoa, wait a minute now. Let's see. We got a lot of cost. We're going to sell them for 180, right? Now, what is our variable cost? $30 for materials and $25 for labor and $17 for what? Okay. Then what is my variable cost?
$72.
Now it says selling administration overhead is $25,240. That's fixed. Production overhead is $37,400. See, the problem here is we got production. So our contribution margin And we did 2 income statements before. Now, when we do this sales minus variable cost, gives us contribution margin minus fixed cost, and we're looking for net income or profit, a variable cost has to include all variable costs, factory and selling. So that's our problem here. Fixed cost has to include factory and selling. All right, what is the answer right here then? 100 and what? 108. What is the contribution margin ratio? Now, ratio is just dividing the 108 by the 180. What would that give you? 108 by 180. All right, this is problem 16. I'm afraid I may have steered you wrong on something. So we're going to look at that solution real quick. Counting it is hard enough without an instructor giving you a wrong answer. Because I wanted to show you this and make sure we're on the right track to the wrong track. Now we're on the right track right here. Okay. All right, but contribution margin ratio, I told you to take it is the 108 divided by 180, isn't it? I wanted to make sure, which is, but you give me 60%?
I did it the other way. I did it that.
All right. And then break even would be all your fixed cost. We've got to add 37 and 26 together, or 25. And we can divide that by the contribution margin because contribution margin is sale price minus variable cost, isn't it? So your break even is, fixed cost divided by CM. That's another formula. Fixed cost divided by contribution margin. Okay, your break even here then in units and in dollars. We'll look at that later. But I'm going to let you go today, and we're going to call it a day. Now, I'm going to get a tax test and have it ready for everybody who wants to come early and take a tax test. I'm going to sign out today and cut off the video.